the move lower in stocks, albeit slight. You know, from where we started the show, I wonder, Joe, if the market's trying to read Williams as a little bit hawkish. Who knows? But it does seem to be a move, perhaps based on maybe the market was expecting something different from him.
So no real change in the perspective of the Federal Reserve, right? Status quo. What does that mean to the market? That means to the market, yes, maybe you get 50 basis points in December, a deceleration from the 75 basis points in prior meetings. But it still means that the one type of inflation, Scott, that the Federal Reserve can control is asset price inflation.
Yeah.
Real economy inflation, it's hard for them to really be able to affect that. But asset price inflation, the Federal Reserve can affect that. I still think that's a priority to them, and I think that's why the upside's limited.
I know why the market seems to be moving the way it is. Maybe it's Bullard, who's also speaking as we speak, who I'll give you some of the headlines here, which seem to be the result of what you're seeing in the market. Now, again, albeit slight moves. Markets underpricing risk that the Fed may be more aggressive, risk that the Fed will have to go higher on rates in 23. Fed will have to pursue rate hikes into 23. He's speaking at an online event, but nonetheless, maybe those are some of the comments. He says the Fed needs to get to the bottom end of a 5 to 7% rate range. Remember, Jenny, he sort of spooked the market a week or so ago where he threw out that the fact that the 7% was even in the conversation, at least for him, sort of spooked the market. It's Bullard. I mean, it's kind of what he does. It is his last vote coming up in December, right? Not a voting member in 23. So he's maybe leaving with a bang.
I'll give you another perspective, though. Maybe it's not Bullard, and maybe it's not the Fed. Maybe it's the fact that we ended last week trading at about 18 times expectations of $230 earnings for next year, and people are saying to themselves, you know what? That feels a little rich. Feels like maybe we got a little bit ahead of ourselves. And maybe there's not that many reasons for significant upside from here. One of the things you and I have been talking about, Scott, is can we get to 4,100? Maybe, but that's only 2.5%. That is not inspiring. So what are we doing now? We're starting to consolidate what's happened and thoughts. And you know what we're doing now also? We're shifting our thoughts into the next quarter's earnings, which probably aren't going to be that inspiring. So let's say we come out next year at $225 earnings. Maybe that's what this is really about, is thinking about earnings for next year and moving away from the Fed. Because I'd argue...
I have a hard time believing that.
But here's what I'd argue. I'd argue that everybody and their mother expects 50 basis points.
Yeah.
And everybody and their mother expects Jay Powell, Bullard, whoever, to try to throw a little bit of cold water on if the market gets ahead of itself, because that's what they've been doing. And Joe made a really good point. They can control asset price inflation, and that's what they're doing. And they know that job owning is the best tool they can use. But none of this is exciting or news to me. And as a portfolio manager, I don't care what the Fed says right now.
Well, first of all, a lot of other people. Okay, a lot of other people do. 2.5%. Joe, I think many people would feel is a bit inspiring based on another 2.5% based on where we were. Like if we can finish out this year at 4,100, that's the number that Jenny threw out, and that seems to be the number that people are talking about. I think that would be viewed in many circles as a win. What's your take?
My take is this. I said this a few weeks ago. It's 2022. What can go wrong will go wrong. The market had a degree of technical momentum last week in the middle of the week. It looked like we wanted to go up to that 200-day moving average that everyone looks at and see if you could initiate some further buying at that level. Nothing to do with fundamentals. I understand that. Okay, over the weekend, we get the unfortunate news surrounding the circumstances with China, both from COVID and the protests that are currently going on.
That's what's happening today. Okay. We're talking about today.
That's why the market is lower today. So I think collectively, now you add upon that the information we're getting surrounding the Federal Reserve. And again, the Federal Reserve is not going to allow asset prices to get too far away from them. I think when you look now towards the end of the year, do you say to yourself, what's my risk assumption? And we're talking about 4,100 for the S&P. Forget the S&P. The S&P is not the index that if something's going to rally before the end of the year, Scott, we should be focused on. The only index that I see that can rally into the end of the year is the Dow Jones Industrial Average. That's it. Those stocks within the Dow are the type of stocks right now that represent the defensive positioning that will mitigate your risk exposure in this environment that's totally lacking clarity.